Hello, everyone. Welcome to Retire with Style. I'm Alex, and I'm here with my trusted companion, Wade.
Hi, everyone.
And last episode, we sort of did an investment heavy market review, year-end market review. And while we made a point to talk about that, look, within the context, it's really not a big deal what happens in the last 12 months based on the Earth's revolution around the sun, or is it the sun's revolution around the world, Earth? No, right, Copernicus.
Yeah.
But what we try to do is what's the context and how to really interpret it. And what Wade has created for a few years now, he has these running indices that I think really provide excellent context of how you can take what's been happening and introduce it within a retirement income lens, if you will, view it within a retirement income lens. So today we'll take the market returns last year and view it through a glass darkly. No, I'm kidding. And just review it within the context of these retirement distribution rules. And Wade, you want to take some time and just start laying the groundwork for this?
Sure. And so, right, this retirement income dashboard, I believe we started in 2015. It's been quite a while. It's been available. It's not something that I used to update it quarterly. That I think before January 2023, when I updated it, it had last been updated in April 2021. So it has been a little while. But
Wait, I think there's an inverse in terms of the number of emails you get relative to the amount of times this has been updated. You know, since 2015, and now, I mean, you've kind of blown up in a good way.
Yeah, that could be.
Yeah, and because of that, I must say, Wade, I'm noticing we now are putting these podcasts on YouTube, and we got a great review. But they did say, hey, we're talking too long, so this is an exhibit of that. But now that we're on YouTube, Wade, did you cut your hair recently? I think you're due for a haircut. I've never seen you with hair this long.
No, I got a haircut actually last week. I would have had much longer hair. This is though the first haircut I've gotten. I was noting in almost 20 years that wasn't just a simple buzz cut. So.
Oh, really? Did you drive with the windows down this morning then, or something?
Yeah, I did wear a hat when I took my kids to school this morning, and I may not have.
Yeah, look at you fixing it.
The bedhead.
There you go. There you go. No. You look sharp. It makes you look hipper. Yeah, all right. Sorry, I digress, Wade. So you haven't updated them. 2015, you were updating them quarterly. Take it away.
Right. So it's really, there's two different aspects of the retirement income dashboard, and the top part we'll talk about first. And that's, I thought, a really cool concept. It didn't take off necessarily in the way that I thought, wow, this is revolutionary back 7 years ago. Maybe it still has some potential, but I think it's a really interesting idea. We'll talk about that first. And then the second part of the dashboard is getting into all the numbers, that if you were looking to build a retirement income strategy today, how much could you get through a bond ladder, through an annuity, through a distribution strategy from an investment portfolio? And that's what the dashboard is all about. It relies on the idea that as interest rates fluctuate in particular, and probably most importantly, that impacts sustainable spending from bonds, from annuities, from an investment portfolio. And so it tries to put some context around that idea. And that sort of discussion gets in the news a lot with Morningstar. I was part of the original Morningstar study back, again, this was maybe 2013, 2014. That's since been taken over after David Blanchett left Morningstar by some of the other folks there. But they provide updated numbers on safe withdrawal rates. And they talked a while back about a 3.3% withdrawal rate, most recently a 3.8% withdrawal rate. And it's the same sort of context or concept of what the retirement income dashboard is doing, which is just providing that sort of update on sustainable spending strategies based on the market environment that changes over time.
To your point, Wade, there's kind of these two start of the year reports that come out that kind of get headlines for the week and then die off. Well, there's three things. The first one is always people have fun, always pointing out how wrong people were the previous years in terms of their forecast. You know, there's always that you can always look forward to every year, right? The best headline I saw was profits and losses, but profits spelled as in like a biblical prophet, if you will. The second sort of article that you see pretty consistently at the start of every year is what's the expected return of the stock market going forward? Because new dividends, PE ratios, etc. And then the third one that's a newcomer that I'm seeing now more and more is what's the safe withdrawal rate right now? And so I think you were ahead of the curve, with regards to that. I think
Hmm.
this
Yeah, that.
this is an important part. The other thing is we're talking about a dashboard, just so you know. This is on retirementresearcher.com /dashboard.
Hmm.
Retirementresearcher.com /dashboard. We'll put it in the show notes, but this is actually a great resource. If you're an advisor, it's a great resource to start getting like quick and dirty numbers, to get an assessment of things. And if you're a consumer, it's a good reality check, from a saving standpoint and from a distribution standpoint.
Yeah, and if that /dashboard is too much to remember, if you just go to retirementresearcher.com, there's a tab along the top of the webpage. It's home, about, articles, resources. If you hover over resources, the dashboard is on the bottom of the list there. So it's pretty easy to get to. It is freely accessible. It's not behind any sort of paywall or anything. And it's updated somewhat infrequently, but it gives you that look at where we are in terms of sustainable spending in retirements over time, and provides some historical context around that. So
Okay.
that being
And
said, shall we dig in?
yeah, let's go down the list. The first one is called the Retirement Wealth Index. I think to keep it consistent, maybe a description of what that is, what are some assumptions, and what do the numbers say? What do you think, Wade?
Mm-hmm. Yeah, and this I thought was a pretty neat idea going back 7 years ago or so.
It still is, Wade. It still is. It still is, buddy. You're doing God's work.
It didn't catch like wildfire or anything, but it's there, and the idea is to just provide some sort of benchmark around if you've been saving consistently for your retirement, how much should you have saved up, and how would that compare on a historical basis to people who are following the same sort of investment strategy as you, but just had different market returns because they were saving at different periods in history. So it's a pretty simple idea. It doesn't translate directly into any real world situation, but it's an index. It's for the last 30 years, I've been saving for retirement. My salary has grown with inflation over the last 30 years, and I save 15% of my salary each year. I save and invest over that 30-year period. And I invest in a target date fund. And the target date fund strategy is reflective of kind of the average target date funds that you'll find out there. And it's the idea you invest more aggressively when you're 30 years away from retirement, and you work your way into a less aggressive stock allocation as you get closer to retirement. And then it's just reflecting. Mm-hmm.
No, go on.
Yeah. How much wealth do you have at your retirement date? And in January 2023, you would have had about 9.8 times your final salary. Again, with these simplified assumptions, you've been investing for the last 30 years, saving 15% of your salary a year, investing it in a target date fund. Doing that would have allowed you to accumulate 9.8 times your final salary.
Okay.
And that is on the low side.
So let me put this in one more perspective. So I'm a 35-year-old person, and I'm going to save for the next 30 years until I'm 65 when I retire. Mm-hmm. You have to start at a number. So you pick some sort of basic number, let's say 100 grand or whatever, right? And you start saving, right? From 35 to 65, consistently saving 15% of your salary, and your salary is affected by inflation. Correct?
Mm-hmm. Mm-hmm.
Okay, so then it changes, right? So at the end, I'm 65 years old, and that $100,000 salary is now whatever. But more importantly, let's say the 100,000 salary is inflation was zero, right? And so you still are making $100,000 35 years later. What that's saying is your wealth would then be 9.8 times that, $980,000. Wait, correct?
Yeah, whatever the final salary is.
Yeah, whatever the final salary is. So that's how much you would have accumulated. 980,000. No, that's fine. That is at the 17 percentile. That means that that number is lower than 83% of any other 30-year periods since 1950. Is that correct?
Hmm. Yeah, those 30-year periods are calculated since 1950, so using data going back to around 1920.
Okay. And so
And right,
interestingly, perfect. No, no, no. Go on.
well, the highest that ever was just slightly past January of 2000, when you would have had more than 19 times your final salary. The lowest that ever was back in 1982, when you would have only had about 7 times your final salary. And really, the only times that you would have had less wealth than at the present was that gap from the late 1970s through the mid 1980s. During that period, you would have accumulated less. And also slightly in the early 1950s, you might have had
When he
slightly
means
less
less, he means less
benefits.
than what you would end up with right now. Remember,
Yeah, less is
this is
that, less
actually,
than now. The
yeah, yeah.
9 point, less
9.8
than
is a low
9.8.
number, historically
Mm-hmm.
speaking.
Mm-hmm.
Okay. And
And at any other point, you would have had more. And even a year ago, so in early 2022, that number was about 11 and a half times the final salary.
hmm, you know what gets me upon looking at this chart? Because there's a lot of variability here, right? You're right. I mean, in the like right before the dot-com crash, if you would have followed the same disciplined strategy of saving, you would have had, roughly 19 times your salary. Whereas now you do the same disciplined saving, you only have 9.8, 10 times your salary. Same consistent disciplined strategy. It doesn't mean that the person that did it now is wrong. It's just how much fortune plays into your
Mm-hmm.
retirement account. It's interesting. It's still it's stocked for the long term, yes, and it's still better than just doing nothing with it, not saving, etc. But it's funny, huh? Wait, how it's funny, not in a
Yeah,
comical sense, but just
it
interesting.
illustrates the lifetime sequence of returns risk, because these are
Yeah,
people who are
exactly.
behaving in an identical manner. They're great savers, saving 15% a year for 30 years. And it's just, what was the sequence of returns they got? If they retired in 2000, they've got almost 19 times their salary saved up. If doing the same strategy, if they retired in 1982, they've got about 7 times their salary saved up. It's a big difference. And we talk about sequence of returns post-retirement, but
Yeah,
it applies pre-retirement as well. It's kind of, were you in a lucky scenario when you're doing your savings, or were you in an unlucky type market scenario? And it's the market returns close to the end of that 30-year period matter a lot more, because that's when you have all your savings accumulated and you've put money into the account and all your savings are being hit by those returns, compared to early in your career when you haven't put much into the account yet.
yeah, you're right. I mean, this is the worst time than the 70s through the early 80s and the start of the 1950s. Really, this is comparable to those times.
Yeah.
Sorry, everyone. No, I mean, it's one of those things. Uh, And how does this dovetail into what you called in the next graph the retirement affordability index?
Right. So the retirement affordability index, and actually there's some good news, not great news necessarily, but good news coming
We don't
out of
want to.
this.
We want to keep it consistent. No, no, I'm kidding.
No, but that's taking your wealth number and kind of just doing a simple calculation on what sort of like annuity income stream could you generate with your savings. Not that it's not the recommendation to buy the annuity from that, but just where interest rates are and how that impacts what sort of sustainable spending strategy you'd be able to do. And with the retirement affordability index, the fact that interest rates did come up quite a bit in 2022 kind of leads to an interesting scenario. So the replacement rate, and this is still not a great number, it's 38.7%. And what that means is, based on the fact that you had in January 2023, 9.8 times your salary saved up, when you turn that into an income stream based on where interest rates are, you could expect to replace 38.7% of your salary. Or to put numbers on that, if your salary is $100,000 at retirement, you'd saved up $980,000, and you could expect to have an income stream generated from that at $38,700.
So if you wanted to buy a personal pension, hey, I don't work for the school. I don't work for whatever some government agency. I don't have a pension. I want to buy a pension. This is the going rate of what you could get.
Mm-hmm.
Your 980,000 right now will buy you roughly $38,700 worth of income a year.
Yeah, and that's inflation adjusted. I didn't mention that, which today, well, and this will come up again later, you can't purchase a CPI adjusted annuity right now. So you couldn't actually purchase the financial product that would give you this income stream. But if you could, it would offer about that particular level of income.
So if someone's asking, what about a non-inflation adjusted annuity, just directionally, what do you, if you had to like guesstimate, what do you think?
Well, it would be the same idea that interest rates have been coming up, and that would support more.
Okay. More income.
It's just it would not adjust for inflation after that point. Now,
I got you. The 38,000 would stay steady, is what you're saying on this one.
mm-hmm.
Got you.
Yeah, steady with inflation growth, just like how the 4% rule is designed. And this number is actually not that far away from 4%, given that what we're talking about, almost 10 times the salary saved, and then almost a 40% replacement rate. But this number would have been the highest again around the year 2000, where you could have had more than 100% replacement rate. You could have more than replaced your pre-retirement salary with the savings you accumulated based on interest rates at that time. And then even though in the early 1980s,
you would have gotten a raise.
Yeah, you would have gotten a raise, actually. You're closer to 110%. And it's been higher, like in the early 2000s, after the downturn, like after 2002, when markets started recovering again. That number was hovering between 70 and 80% as a replacement rate. The financial crisis brought it down to around 50%. And then as interest rates continued to decline afterwards, that number since the financial crisis has just been somewhere between 40 and 50%. And then just over the last couple of years, when interest rates got to such extreme lows, dipping below 40%.
Well, Wade, why are you saying, and I wanted to make sure everyone catches the caveat, because you said it, but I want to make sure it's sort of digested. Even though the markets have gone down because interest rates have gone up, the actual retirement affordability index hasn't been hit as hard as you would think.
Right. And that's the silver lining. And I think this applies a lot to just the broader issue of a lot of people listening may have less financial assets today than they did at the start of 2022, because 2022 was a really rough year for stocks and bonds, as we reviewed with Bob in last week's episode. But at the same time, you have those losses, your portfolio is smaller. But now looking forward from today, interest rates are also a lot higher. Part of the reason your bond portfolio lost is because interest rates have been rising. And that increase in interest rates is offsetting the loss of financial assets, so that the replacement rate available today did not drop. It stayed steady, even though the retirement wealth index did drop noticeably over the last year.
Okay. So far, what we've come, just to begin to, because we're speaking numbers and in episodes where we're talking a lot about this, it's good to just level set. So far, where you are right now, if you would have been a diligent saver, and if you retired January the 1st, you'd be walking out with your save. If you look at your statements, it should be roughly 9.8 times your current salary. Boom. That's historically at the 17th percentile. So there have been 82% of the time, it's been better. That being the case, if you were to turn around and take that 9.8 salary, which out of, let's say you started with $100,000 when you began this experiment, and there's been no inflation, and your salary is still $100,000 on the day you retire, you walk out with, you should have roughly $980,000 in your nest egg from this. That could support buying an annuity that will pay out $38,700 a year, 38.7% replacement rate. We've been kind of buffered a little, not buffered, but we've been cushioned a little bit the past few years because rates have been going up, so that's helped out on the payout amount. But it's still, on a relative basis, since 1984 or 82, is pretty low. The replacement rate was over 100% in the year 2000s, but it's been going steadily. After the financial crash, it really sunk, and we're hovering around 40% the last few years. So far, so
Mm-hmm.
good, right, Wade?
Yeah, you got it right. And also, because this is based on a real inflation adjusted income, we haven't had tips for the whole history. And the Cleveland Federal Reserve Bank does estimate real interest rates going back to 1982. So that was the constraint on this chart, that these numbers go back to 1982. And the replacement rate was higher in 1982, even though the retirement wealth index had a lower number. Interest rates were quite a bit higher in 1982, and so still the replacement rate then was around 60%. And even though the wealth accumulation index is less today,
but you've answered right. You've answered for this person, the hypothetical person reading this. Okay, I should have this amount of money. Check this amount of money. If I wanted to be protected income at its most extreme case and buy a pension on the open market, I would be getting a distribution of 38K,
Mm-hmm.
and let me be exact here. 38.7K. Now, if I don't want to buy an open annuity, and let's say I'm time segmentation in its most extreme case, where I'm just buying a dedicated portfolio. I don't even know that's time segmentation, really, but if I'm just getting a dedicated portfolio, and what I mean is you're getting bonds, you want to set it up. So we've checked off the annuity sort of income only piece. You want to talk about the next one, which is sustainable spending from just dedicated income sources?
Mm-hmm. Yeah, and so as you scroll down the dashboard, you get into the sustainable spending from dedicated income sources, and it shows spending numbers, spending rates for 30-year bond ladders, as well as for single premium immediate annuities. These examples are for a 65-year-old couple, joint and 100% survivor benefit. So the same income for the lifetime of both individuals, and it is a life-only annuity. It's the bond ladder numbers are based on the long-term, real and nominal long-term interest rates on January 1st, 2023, and the 30-year Treasury was at 4.11% then. It's declined since then, actually. Interest rates are so volatile these days. The 30-year TIPS yield, the Treasury inflation-protected security, was at 1.78% at the
Wait, that's
start of the
okay,
year.
because we'll publish this next week, and maybe the rates are back to where this was fun.
Yeah, keep your fingers crossed for that. But yeah, that's then okay. If I could get an average yield out of my 30-year bond ladder based on that average long-term real interest rate, which is I was saying 30 years, but these are, I meant to say, these are the long-term average interest rates as reported by the Treasury Department. So the average long-term rate was 4.11. The average real long-term rate was 1.78. And that does correspond to if I actually went through the mechanics of building a bond ladder with the entire yield curve available. If you build a 30-year bond ladder, what you're looking at is for spending with no inflation adjustment, so just fixed spending, the spending rate would be 5.62%. And that would give you, with bonds, 30 years of spending, no increases for inflation. If you had $1 million saved, $56,200 a year, not inflation adjusted, and you'd spend your portfolio down to zero at the end of the 30th year.
So you're 65 years old. You're putting your life expectancy as 95.
Mm-hmm.
Because you're going to have zero money after, because you're using 100% bond portfolio, but you're taking the yield, and when they mature, and then you're going to use those maturities as well, et cetera, et cetera. So you're saying you could take out from that 5.62.
Mm-hmm.
Okay.
Mm-hmm.
So
now,
that compares favorably to the 4% rule, right?
Well, yeah, although this one wouldn't be, there's a later number coming. So it depends on the spending strategy. The 4% rule equivalent's coming up soon. But the next number is...
I was trying to preview it, but okay, you're right.
I think, I've been making that point for years. And actually, David Blanchett, I think, just released an article on Think Advisor encouraging people not to confuse fixed spending for inflation-adjusted spending. So the next number is, I want my spending to grow annually at 2% as a fixed number. So not pure inflation adjustments yet, but just a fixed 2% growth rate on my spending. with the built-in ability to grow spending at 2% a year, the initial spending rate I could use with a bond ladder would be 4.41%. So 5.6 drops down to 4.4 to allow, it's an lower initial starting point, but then spending will grow at 2% a year for the 30 years. And then the CPI adjusted number. So this is the one that's more equivalent of the 4% real logic, where you have constant inflation adjusted
constant inflation.
spending
I was thinking more
that matches
sustainable,
the
but
CPI. And you get that by investing. This 30-year ladder would be built with TIPS, Treasury Inflation Protected Securities. And to make the 4% rule work, you need about a 1.3% real rate. Well, the real rate was 1.78%, and that translates into a 4.25% sustainable spending rate for that 30-year period with inflation adjustment. More than 4%, which for a long time it was going to be less because interest rates the entire TIPS yield curve was negative at some points, and that supports a much lower spending number than at the present. We're now at, again, 4.25%.
So if you lock in now on 100% bonds, making it a dedicated portfolio, assuring you both don't live to past 95, this is what you would get, right? It's kind of it's not the end of the world, really.
Yeah,
right?
It's much more attractive than past
yeah, exactly,
with lower interest rates.
This is one of
now,
these
that would be a
usually...
little bit.
Go on.
I mean, today interest rates have come down. They're still above the number needed to have 4% work, so it's still above 4%, but it wouldn't be quite 4.
I know, but you would be getting that without any market volatility. It's a dedicated bond portfolio, so there's
no market volatility.
It's a huge kind of thing. How does this compare? You have it on the other column. Obviously, I'm looking at it, but I just want to verbalize it. How does this compare to the SPIA, the single premium immediate annuity, life only, if you were to buy an open market pension from a distribution standpoint, apples to apples?
You've got a couple. They're both 65. They're buying life only joint SPIA to provide an income for the rest of both of their lives. So it's not fixed to 30 years. If they don't live very long, they're not getting as much. If they live a long time, they know they're going to get the spending they need to match their lifetime, their joint lifetime. And for the fixed spending, it's 6.42%. And this is the average of the top 3 quotes available at immediateannuities.com. That's where these numbers are coming from. But the bond ladder was 5.6. The annuity, providing the equivalent fixed spending, is 6.4%.
With the caveat that it's not adjusted for inflation, it's just straight up flat number.
Well, neither of these numbers are adjusted for inflation.
Yeah, exactly.
Yeah, that's right. And it's higher because the joint life expectancy of the couple is less than 30 years. Then you've got the 2% cost of living adjustment spending goal. The annuity with a 2% COLA has a 5.1% payout compared to 4.4% for the equivalent 30-year bond ladder. So again, higher spending power, longevity protected, but then your beneficiaries don't get anything in this scenario if you live less than 30 years. But you know you're covered if you live more than 30 years. That's the trade-off, in addition to the higher income.
You said it with the life expectancy comment, but why would we expect to see a number in which the annuity is actually on a distribution basis paying out a little higher? So folks can kind of understand.
Because, well, the annuity, it offers the risk pooling, so it's calibrated more to the life expectancy. And so if 50% of the couples don't have somebody making it to 95, the insurance company doesn't have to plan the spending to last to 95 in the way that the bond ladder does. And that's why you're getting the situation that the annuity is offering a higher payout rate. The longer the bond ladder is meant to last, the lower the spending rate it could provide. If I only wanted a 20-year bond ladder, that would give me a higher payout rate than the annuity, because the annuity's projected life expectancy would be more than 20 years. But in this scenario where I want the money to last for 30 years, the bond ladder's going to give me less spending than the annuity.
Okay. So you've taken, just in the process of this, we've looked at what would happen from a replacement rate buying an open market pension, if you will, a private pension, hence an annuity. What would happen if you, instead of doing that, buy a complete dedicated portfolio. And dedicated portfolio is you're buying individual bonds that are providing a yearly yield, and they're maturing, and you're just taking all of those assets and using it for for your distribution. And then you compare that fixed 2% COLA CPI adjusted to an equivalent annuity to assess just the percent distributions. We're not doing that with the individual annuities simply because for CPI adjusted, because there is no annuity that sells per those, per that characteristic.
Yeah, since January 2020, no commercial annuity provider offers a CPI adjusted annuity. Social
Now
Security is a CPI adjusted
yeah,
annuity,
exactly.
but
Now you can say
there's
why
no
doesn't anyone?
commercial.
Oh, we get this question a lot. Why doesn't anyone offer that? That's one of these first things that comes up. I mean, you kind of have to make do with a cola that you feel comfortable with, because I would say, and please correct me here, Wade, insurance companies, it's very hard for them to price it. And so, because inflation is so volatile, and it's hard to price it, that they would have to charge you so much for that it wouldn't make that much sense ultimately.
Yeah, they can't hedge the inflation risk beyond 30 years. They can up to 30 years, but for those payments that go beyond 30 years, they don't have any mechanism to hedge that risk. And so that makes it harder. I think it's partly a supply and demand type problem as well, where when they offer those, the consumer interest is minimal. And kind of the running joke is when they did have CPI adjusted income annuities, hardly anyone purchased them. Hardly anyone searched out for them. There was one relatively recent New York Times article where the author actually sought out the one person that bought a CPI adjusted SPIA through one of the major online annuity sellers. And that
And how
person
did you
was a
respond
retired
when they
actuary.
contacted you? How did you respond when they
No, it
contacted
wasn't
you,
me.
Wade?
But it was a retired actuary living in Arizona. And actuaries may understand the value of inflation adjusted income, but
He
it's
saw an arbitrage.
they
He saw
saw
an
the opportunity.
opportunity.
And he was probably pretty happy when inflation started picking up these last couple of years too.
All right. All right. And so then as we go down this dashboard, what's where do we take this now? Now, okay, we did all those kind of, it's not too dissimilar from going through the RISA and strategies and all of that. Now, from a total return standpoint, what do you got?
Yep. And so that's where, okay, what's the safe withdrawal rate? Like, does the 4% rule work, or what's the equivalent of a 4% rule? And that's what the next table, the sustainable spending from volatile investment portfolios, addresses. And so it looks at different spending strategies, and then it offers the spending projections for conservative, moderate, and aggressive. And those just relate to what kind of asset allocation will you use, how long do you want the money to last, what probability of success are you seeking, and so forth. And so when we talk about something like the 4% rule, the assumptions for that would be the closest to the moderate scenario, where the 4% rule, strictly speaking, was based on historical data with a 100% success rate. But if you start to translate that same data into a Monte Carlo simulation, you're looking at around a 90 to 95% success rate for the 4% rule with a 50 to 75% stock allocation. And so that's the closest to the moderate scenario, which is you're going to use 50% stocks in retirement, and you want a 90% chance that you don't deplete the portfolio by 30 years into retirement. The conservative scenario is you use 25% stocks, and you want a 95% chance that you have at least 10% of your wealth remaining by the 35th year of retirement. And then the aggressive scenario is you're going to use a 75% stock allocation, and you seek an 80% chance that you will not deplete your investments by year 30 of retirement.
You got all of that, guys?
We've got numbers here. There's the 9 numbers because there's those 3 different spending strategies for these 3 different sets of assumptions. And then it also gets into what if you had a buffer asset, and also what if you use a variable spending strategy.
What I would recommend is we did a whole series on sustainable withdrawal rates. And so if you're in this dashboard and you're looking at it and you're seeing like the Guyton Klinger decision rules and things along those lines, just to have a listen to those episodes where we discuss them. just to help you along the way with regards to these items here.
Mm-hmm. And when we did discuss the Guyton and Klinger decision rules, part of that conversation was I was explaining how for the analysis we were talking about that day, I simplified the rules because I think they're just way too complicated to use in real life. This table, going back to when I created this all 7 years ago or so, this is using the more pure version of the Guyton and Klinger decision rules. And the notes do explain the particular decision rules used for that.
Okay, and so what's the number? Everyone's waiting.
Mm-hmm. Well, so if you're just talking about fixed spending, and we'll just mention that briefly first, because it's not what people are usually thinking of when they talk about safe withdrawal rates. But from conservative to moderate to aggressive, you're 3.7%, 4.88%, 5.38%.
And by fixed spending, you mean you have $100,000, and I'm going to take out $4,880 a year.
Mm-hmm, that's
for
the moderate
for the rest of my life. Yeah, that's the moderate. For the rest of my life, that's the exact number that I'm taking. I'm not adjusting it for inflation or anything like that. It's fixed.
Yeah, and then, right, no inflation adjustment. And since that's the moderate number, it means you're using a 50% stock allocation. And then you have a 90% chance that by doing that, you're still going to have money left after 30 years.
And the range on that is 3.7?
You ran out.
Oh, sorry, wait.
So just a 10% chance that it's empty. You've run out before 30 years. And that's quote unquote failure for that retirement.
Okay. 4.88. I'm liking it. Mm-hmm. But again, that's no growth. That's a steady number.
Yeah. Then with a 2% fixed COLA spending, your conservative number is 2.73. The moderate, 3.8%. It's getting closer to the 4% rule number. Now this is still 2% COLA, not true inflation adjustments. It's a coincidence. Well, it's some relationships, but 3.8 is the number that Morningstar recently came out with. Well, 3.8% is my moderate number for spending with a 2% COLA. And then the aggressive number is 4.24%. The inflation adjusted spending, now that's the one that's really the 4% rule assumes inflation adjusted spending. And before saying these numbers, just to explain a little more, the simulations I'm doing here start from today's inflation levels, interest rate levels, primarily. They use the historical stock market risk premium, and then they allow both inflation and interest rates to evolve over time. So when we look at what do the yield curves tell us, over the next year, the markets are expecting inflation to be around 3.4%. In 2022, inflation was 6.5%. But inflation is expected to come down quickly. Over the next 5 years, the average inflation rate implied by the markets is only 2.3%. And we talked about this as well in last week's episode. So
and you actually have in the dashboard, we're probably not going to discuss that today because we did last time, but if you go to the bottom of the dashboard, we kind of show how to calculate sort of an expected inflation, right?
Mm-hmm. Yeah, and it's just the difference between treasury yields and TIPS yields.
Wait, so come on. We wanted to make it sound like it was a lot more than that. You when you say it's just simple subtraction.
You're trying to get people to listen to last week's episode.
There's no intrigue, man.
I spoiled it. Sorry.
No, I'm kidding. Things don't need to be complicated. It's simply subtracting out the tips out of the equation.
Mm-hmm. But there is a sequence of inflation risk. And that's just because inflation is higher at the beginning. That's going to make this inflation adjusted number a bit less than the 2% COLA number, quite a bit less than what it would have been in the past when inflation started from a lower point. And so, well, the conservative number is 1.9%, the moderate number is 2.93%, and the aggressive number is 3.38%.
Okay, so in your world, and we get these interviews all the time from journalists. What's the new 4% rule? You would kind of say 2.93%, but all is
that
not
would be
lost.
The closest to the. Mm-hmm.
All right, but all is not lost. Wait, I would say sorry. Just I want to get this point across because you mentioned Blanchett, right? We don't spend. It's not realistic. We don't spend like the 4% rule. You spend like with a blend of all of these things above it as well. The 2% cola. Sometimes you don't pull the full inflation, and sometimes you don't put any inflation growth. So I would say, somewhere between 2.93 and 4.88 in a moderate portfolio is kind of what you would be looking at, because the
Hmm.
reality is no one just locks in on something and flies blindly. There's constant calibration that happens year to year, and it's some sort of blend of that.
And also, as Bob was talking about last week, the 6.5% inflation rate for 2022 is kind of a historical artifact in that most of that inflation happened in the first half of the year. Inflation was a lot lower in the second half of the year. And I didn't make any sort of adjustment for that. But to the extent that maybe inflation's already coming down, that would help bring that 2.9% number up higher. So I
Wait,
really
have
am
you been to the
more
grocery
comfortable.
store? Did you go to the grocery store
Well,
this week?
eggs. Yeah, eggs are the exception, right? No, I've seen some restaurant menus have 50% inflation rates and so forth. It's kind of wild, but overall, I would be comfortable. Like that 2.9% number is quite a bit lower than the 3.8% that you get with the 2% spending cost of living adjustment. I'd be comfortable really saying something that's closer to the 3.8% number. I mean, it's got to be a little bit less than that to account for the CPI
Well,
growth. But
especially considering that if you look at the expected long-term inflation rate, absent what's going on right now with Powell, is going to raise, is going to, those kind of daily market machinations. Yeah, if you look below 5-year projection to be somewhere like 2.3, right? So I agree with you 100% with what you're saying, that the current 4% rule looks like it's 2.93 because it's taking the year-end inflation number, when that's kind of a little bit of a anomaly.
mm-hmm. And I don't want to make those kinds of judgment calls where I completely just the methodology is you use last year's inflation number. I don't want to start parsing that out into not
Well, you have
having
to
a
be
justifiable assumption. So
no,
that's
no,
why I
but you have
kept
to be
it as is.
consistent and leave it there. But yeah, I get it.
Mm-hmm.
There's a caveat to this.
Mm-hmm. Yeah, and the caveat again being probably you could use a little bit higher than that 2.93% because it does look like inflation is coming down and we're not going to have anywhere near the 6.5% inflation rate for 2023.
And then we had 3 more of these
Yeah,
buffer
then we've
assets. There
got,
we go.
well, what if you had a buffer asset? So what
Now
if
we got time
outs
segmentation.
well,
Well, not
time
really, because it's a
segmentation
buffer.
was
Yeah, yeah, it's
somewhat
a buffer.
addressed
Sorry.
with the bond ladder. The buffer asset, what if you had outside of your portfolio 5 years of spending available? It could be a reverse mortgage line of credit. It could be whole life insurance. It could just be a big pile of cash that you don't count as part of your portfolio. Then you just have to be careful that, well, if you move cash out of the portfolio, maybe you can use a higher withdrawal rate on your portfolio, but you have less money in the portfolio now, so you're not necessarily any better off there. But just maybe at this point, sticking with the moderate assumptions to not have so many numbers to talk about. If you're looking for that 2% spending adjustment on the inflation and you had a 5-year buffer asset on the sidelines, you could start with 4.7% out of your portfolio. And that's 4.7% of the portfolio, not 4.7% of the portfolio plus the buffer asset. So that increased it from 3.8 to 4.7%. Having a buffer asset can have a big impact. Equivalently, with the CPI adjusted spending in the moderate scenario, the number increases to 3.62%. So it went from the 2.9 to 3.6 with having that 5-year buffer asset. That can help in a notable way or noticeable way to support a higher spending distribution rate for the retiree. And then the Guyton and Klinger numbers, as we talked about in the past episode when we looked at variable spending, these sorts of strategies can dramatically reduce the initial spending rate. And they just do that by incorporating the ability to make potentially dramatic spending reductions later on. But the moderate number can get up to 5.44% if you follow the Guyton and Klinger decision rules. So, and that's not inflation adjusted spending. That's not 2% COLA. I'm going to use a variable spending strategy that will typically involve making cuts to my spending throughout retirement. And by knowing in advance that I'm willing to make those cuts, I can start at 5.44% as my initial distribution rate in the
Okay.
moderate. So that's 50% stocks and a 90% chance you want to have money left after. The Guyton and Klinger rules do allow you to deplete your portfolio, unlike some other variable spending strategies.
So wait, is it fair to say, you're looking at the investments, it's the year end, starting of the new year. You're looking at your quarterly reports and year end reports, and they're just showing investment returns, right? What's more interesting to us with these kind of adjustments that we make is the context. At the end of the day, especially in retirement, we're not just thinking about accumulation, is how do you source retirement income? And so relative to potential time segmentation strategies, as Wade mentioned with the bond ladder examples that we gave, income protection, as we discussed with buying a personal pension, if you will, through a SPIA, or even total return with these distribution rates, whatever that strategy is that sings to you, I would take a gander of this dashboard just to make sure that the distribution that you're taking kind of aligns with something like this, and it's not off by orders of magnitude, at least on the higher end, simply because that you want to make sure that you're not like out of whack with the realm of reality, if you will. And so that's if I'm a consumer listening in, I'm kind of looking at it like that. I'm looking at whatever my money I'm taking out, be it the rolling ladder, this or that, and just getting a sense of, okay, this is what I'm looking at. Obviously, if you're getting ready to retire, you can also just take a look at what the economies of these things are, and know what you're getting into, from a realistic standpoint. If I have a question, though, wait. Oh, sorry. Go on.
Was before it's kind of worried you're going to wrap things up because there's
No,
still
I have
another.
a question. I wasn't going to wrap it up, but go on.
It's going to try to stop you
Never.
from ending the episode. No, the dashboard was created before we had the retirement income style awareness, but there is also an example here of the income protection strategy, which is so we're back to the scenario of 2% spending growth. If we're thinking we're moderate, we're looking at a 3.8% withdrawal rate. If we thought about, well, what if we build a floor of lifetime income with 30% of our assets in an immediate annuity with a 2% COLA, we'd have a 5.1% payout rate there. What if having that reliable income in place makes us feel more comfortable with our remaining investments to then shift towards the aggressive approach, use a higher stock allocation, be comfortable with an 80% success rate instead of a 90% success rate? That would also let us bump up to a 4.24% withdrawal rate from the investments. When you blend 30% in the annuity, 70% from the investments, you're looking at an overall distribution rate of 4.5%. So the 3.8% moderate spending number was able to increase to a 4.5% spending rate, blending an immediate annuity with a more aggressive investment approach for the remainder of the funds. And so that's another way you might think about this as well.
You're a magician, man. No. But it's a good point. You're just bringing in. Think about your preferences and how you can kind of blend them. The other piece, what I was going to mention, and you may want to give it some thought here for everyone as a parting thought, is if you're looking at these numbers and they just don't work for you, beyond what you said, what are some things you could do? And where I was going with this, and we started talking about it a little bit, but just including integrating insurance into the investments, starting up higher with a variable rate, knowing that you got to be willing to come down. And it's not unrealistic because your spending doesn't go up as you get older, or even, using buffer assets. You kind of started with the reverse mortgages, but there's many ways to begin to go about kind of helping you with this.
Yeah. There's definitely approaches that can get you above 4% now as a distribution rate. And so if you've got that 4% rule in mind, not everything will get you above 4%, but certainly with some flexibility and with some kind of combining different approaches, you might be able to get to a position where you feel comfortable with a number like that for spending in retirement.
Well, wait, I got a little bit of bad news. Because of the inflation, I think we're going to get a lot of write-ins for you to update this for the end of the quarter. What do you think? No.
It's not that hard to update. I could do it more frequently, so we'll see. Yeah, maybe that was the original idea.
I'm just
every
teasing
quarter.
you, man. If we need content for the podcast,
April.
we'll update it, and then we can.
Now,
we got a show in the back pocket.
If somebody listens to this episode in the future, they'll say, "Wait a second, none of these numbers match up." And that may be because we updated it since January 2023.
But again, for us, this is what we mean when we say, okay, what do the stock market returns have in play for us? We don't look at it from like an investment point of view of, forecasting some magical thing. We look at it from the point of view of what does this tell us from a spending standpoint? Because we can do more with that. And ultimately, that's more of the end game for why you're investing anyways. So I strongly encourage you to check out retirementresearcher.com/dashboard. Or like Wade said, just go to retirementresearcher.com, resources, dashboard. And you'll figure it out from there. So thank you for that on my end. Wade?
Yeah, thanks everyone. Hope you have a great week. And thanks as always for listening to Retire with Style.
All right. Take care.